Hey everybody, there's something I want to talk about here, and I've been doing a little research on, is the relationship of equity markets and relationship to gold over time. In this scenario, I use the S&P 500 just because data is readily available and it goes back a long period of time. And if you can see here on the Excel spreadsheet here in the first column, I have the S&P 500 and the value, excluding dividends, and then the cost of 1 ounce per gold over time. From that we can derive a ratio of the S&P cost to 1 ounce of gold. I've also added a column for the annualized return. So for example, if we invested 8.1 in 1971 until today, what was the compounded annual growth rate? What I've found here is generally from a high level there's an inverse relationship. Notice over time, once you approach around 2000, which we call the dot-com bubble, that annualized returns have been fairly anemic. Conversely, when there was a sharp decline in the ratio in the last recession around 2009, annualized returns have been higher than their historic average. So one way to break this down is to map the annualized returns against the ratio. And if you can notice that the chart on the left-hand side has a fairly linear relationship until it gets below 1. Anything below 1 has shown very favorable for investors. Most of those data points are going to come from the 1970s when the country was in a recession. The far end of that is going to be the dot-com era, where the returns were anemic, as we saw before. If you look at the right side, you can see a chart based in the returns for 5, 10, 15, and 20 years. The theory has always been hold forever and only sell when you have to in retirement. And if you can notice the blue dots in there, if you only hold for 5 years, the returns are fairly erratic. They haven't gone through a traditional credit cycle. There's a lot of volatility in earnings, and there's other forces outside of just the EPS return that may influence it. For example, a one-time legal case, or maybe you're in an economic environment that's not very favorable to travel and tourism, or maybe the airline industry. But the longer you hold, is represented on the right hand side in gold, you're going to be able to have more and more predictable returns based on what the cost of gold is at any given time. So what we do is we take this data, the ratio of the S&P to gold, then we also take the annualized returns, and based on the ratio we can form a linear regression analysis. The old y equals mx plus b holds true here. And in this case, we've added a multiple of 6 to 1. And for every duration we plan to hold, 5, 10, 15, and 20 years, we can get a rough estimate of what we should expect the valuation of the returns to be given that hold to maturity. Well, at a ratio of 6 to 1, which was similar to the dot-com era, investors should be very, very skeptical about investing in equities at that point. Even if they plan to hold for 20 plus years, their average return is probably going to be a negative return adjusted for inflation. However, if we put what our normal environment is till today, an investor should see that 6, 7, 8% return that you typically would see. Now, keep in mind in the last 10, 15 years, the Federal Reserve has intervened more than historically, so that actually changes what the valuation of the market's going to be. There may be more market confidence and more sentiment to where investors feel more comfortable. They might be able to buy distressed assets and remove those liabilities from balance sheets, which creates a more profitable environment. So how do we use this information? I tend to see things best in tables. So what I've done is in the top, put the gold multiplier and then all the maturities before, and then carried it all the way down to 20 years. Notice the higher the gold multiple, the worse the returns are going to be, and vice versa. Right now we're in a current state of 1.74. And I have 30 plus years till to retirement, to where the timing of my investments aren't quite as critical given historical trends. But what if someone is nearing retirement right now? What if their time horizon is less than 5 years? Look at the volatility between these returns. With the 95% confidence interval, you're saying that the average mean of the sample is going to be between +2 standard deviations and -2 standard deviations. While 7% doesn't sound that scary, or 5% doesn't even sound that scary, look at the vast difference between the negative and positive amounts of what those average returns could be. They're nowhere near as tight as what the deviations would be if you were to hold it for 20 years. So an investor would have to ask themselves, would I be okay earning -7% with a probability of around 5%, 6%, with an upside of 19%? And I would say most say yes. It's my biased opinion that at this current state, the economy's fighting headwinds, EPS is going to start declining, unemployment is rapidly increasing, and there's not as much discretionary income to spend. If the economy is based on a Keynesian model of spending, the optimistic attitude right now is malaligned from the actual pricing. I would be very cautious if someone had under 5 years left in their retirement plan. Well, hopefully you find this information useful. I like to explore using statistics and logic. Please make sure to subscribe.